Hi, morning everyone. Thank you for joining for today's Phillip Securities Research Monday morning call. So today we have quite a lot of results as well as the bonds weekly. So without further ado, I'll be beginning the presentation. First off, we're starting off the three banks. Firstly, with UOB, we will be maintaining our accumulate call with a target price of $20.40. For the positive side, we see that for UOB in the second quarter, they actually the good point was that actually they only recognized $90 million worth of allowances recognized as impaired loans, which what we will always know as SPs, which is your specific provisions. So these specific provisions actually comprise only results in about 13 basis points in terms of credit cost, which is lower than the quarterly average that we observed over the past 4 quarters of 20 basis points. And for general provisions of $378 million, it actually constitutes the remaining 54 basis points of credit cost for the quarter, which is actually in line with the 50 to 60 basis points guidance provided by the company itself. In terms of the negative, we see, of course, for all the three banks in the second quarter, the main theme will be the fall in interest rates. So for the UOB, their net interest income actually fell 12% year on year as their NIM contracted to a historical low of 1.48% from 1.81% in the quarter itself. So then not only was the net interest income impacted as a result of the interest rate cuts, but we know that actually during this period, because it's very volatile, there was a huge influx of deposits as well. So for UOB, their deposits actually grew 7% year on year, which outpaced the loans growth of 3% across the same period. So moving forward, what we would think and the company actually guided for is that the lag effect from the repricing of deposits will leave some pressure on the NIM compression. So we will see NIM for the subsequent quarters rise up from 1.48%. But of course, because of a stellar first quarter, not a stellar, but a normalized first quarter NIM, right? The entire year's NIM will still be lower than what was reported for the first half itself. The second negative that we see is there was a weakness observed across their non-interest income. So apart from the fund management fee, which actually fell by, I think, 3% year on year, other net fee and commission income actually saw double-digit declines year on year across the board. So from wealth management fees and etc., all of them actually fell more than double digits. Other non-interest income also fell by 11% on lower net trading income. So this gives rise to a very kind of like a weak income numbers coming from UOB for the second quarter. For the outlook-wise, first of all, I think most of us will be quite concerned with, not concerned, but most of us are on the lookout for their semi-annual dividend, the cap that was issued by MAS recently. So for UOB, their semi-annual dividend will be cut to 39 cents per share. This is compared to, I think last year was 55 cents. Yep. So this 39 cents will give an annualized amount of 78 cents per share for the entire 2020. And there will be a scrip dividend that is available. So you can opt in for shares with your dividends if you want to. However, they will be issued without a discount. So because I think most of the banks, they don't think that they need excess capital from the savings from the CET1, especially when their dividends is already capped by MAS. They have savings of at least 40% already. So, however, we do expect UOB to resume their $1.10 dividend at the start of financial year 2021, excluding any special dividends, of course. So for UOB-wise, recognition of allowances is expected to remain at the current run rate. So we see for this quarter itself, they recognize almost $400 million worth of allowances. If you think about what they guided for is about 350 to 420 million per quarter. So this will be in line with guidance. And because they have an RLR of $379 million, sorry, I think there's a typo there. We think that the bank is in a good position to weather the COVID-19 pandemic. So we will be maintaining our accumulate recommendation, but we did revise the earnings estimate downwards by 5% because we do see that in terms of their income numbers, it does come down quite significantly, more than 10% across whatever segments that they have. So moving on, we'll be talking about DBS. Okay, for DBS, it will be a much better story. So we are, of course, we are still maintaining our accumulate call at $21. In terms of their positive, what we see is that for the second quarter itself, the gains on investment holdings actually held off whatever downturn from their second quarter operations itself. So total income actually came in at roughly the same level or even higher than what was reported in the second quarter of last year. So what DBS actually says is that currently they are still sitting on another $1.5 billion worth of unrealized mark-to-market gains in investment securities, which they can actually realize these returns if they need to in future quarters if their income numbers still doesn't look as good. So these will provide some buffer for the business operations to recover, and then they can hold it off by selling some of their investment securities. But of course, it's a trade-off between the yield and current. So because most of these investment securities that they are holding are like fixed income, so it actually provides some of them quite an attractive yield that will hold up the NIM numbers. However, if they do sell it, the NIM numbers might come down even more in the subsequent quarters. So in the terms of negatives, same for the NIM numbers. For their net interest income actually fell by 5% year on year, which is lower than what we saw for UOB. This was because their NIM compression was much lesser, 29 basis points year on year. Reported NIM of actually 1.62% in the second quarter and 1.74% for the entire first half 2020. So we are expecting for DBS wise in terms of the NIM to stabilize at the current level. So because of a better first quarter, the entire year's NIM will drop to about 1.68% from 1.74% based on our current estimates. And we also see that actually for DBS, fee income actually fell 11% year on year due to lower business activity in the second quarter due to circuit breaker. So for them, credit card fees fell and investment banking fees fell by 19%, 21% and 19% respectively. So most of the time for DBS, we were looking out for investment banking fees because that is one of their stronger portions of the business. However, as we enter into the third quarter and the economy starts to reopen, we do expect to see some gradual recovery in the fees, especially with some increased capital market activities and more face-to-face interactions, which can help with wealth management. So for the outlook, quarterly dividend has been cut to 18 cents per share from 33 cents in the previous quarter. So this brings 2020 estimates of their dividend down to 87 cents, which is 30% down from the financial year distribution of $1.23. So previously, most people were expecting them to pay out 33 cents every quarter for the next for financial year 2020, which will give them $1.32 for this year. But unfortunately, they are not able to do so due to the MAS regulations. And however, scrip dividend will also be available for the next 4 quarters. So from the second quarter of financial year 2020 to the first quarter of 2021, it will still be will be at this 18 cents rate. For their scrip dividend wise, there is no discount as well. They do not feel any need to show up their capital as well. However, in terms of the second point, there's a reserve build-up is well underway, and we expect DBS to taper off their allowances in financial year 2021. In the second quarter itself, we see that DBS actually added $560 million in GP, which is their general provisions, bringing the year-to-date GP provision to $1.26 billion. So this is also in line with their 80 to 130 basis points in credit cost that was guided for, which results in about $3 to $5 billion that will be booked across 2 years. So if you think about now at 1.26 billion, they are already almost 1 quarter their way, slightly more than 1 quarter of the way if it falls below the guidance. So this is definitely in line with what they actually previously guided for. So we are holding our accumulate call, and we did revise some of the income numbers to reflect some of the resilience that we observe for DBS. We do see that their fixed income and their investment securities will help to hold up their income numbers as compared to the other 2 banks. Okay, next I'll move on to OCBC. For them, we are also maintaining our accumulate call with $8.92 target price for the second quarter itself. Next, in terms of the results on the left, for them, the positive was that their non-interest income actually grew 11% year on year to 1.14 billion, despite a poorer fee performance. So for insurance income and trading income, we saw that it grew 50% and 31% year on year from the second quarter of in the second quarter from last year. So most of it came from the shareholder funds and reversal of mark-to-market losses in the second quarter due to a sharp decline in the first quarter as a result of the Great Eastern Holdings contribution. So this was more like coming off from a low base. That's why they actually can recognize a lot of these income numbers from the Great Eastern side. However, in terms of negative, same with the other two banks, net interest income fell, and it fell by 9% year on year for OCBC on a 19 basis point NIM compression, which is much less than what we saw for UOB and DBS. So the second quarter NIM was 1.60%, which was down 19 basis point from a year ago. And what the company noted was that they actually exited second quarter at a NIM of 1.55%, which is lower than what we saw was reported of 1.60%, but it is expected to recover slightly. So moving forward over the next 2 quarters, they are expecting to see a low single-digit recovery due to the deposits repricing. So secondly, for OCBC itself, I think the second highlight for them was that they actually had quite a high amount of allowances that was recorded based on their what was guided for. So it was mainly due to the write-down of their OSV loan book. So it's the oil and gas sector related, so the service vessels. The loan book actually contributed to a higher level of allowances. So $518 million worth of specific provisions was recorded for the sector in the second quarter. So what they mentioned was that the outlook for this industry itself is particularly bad. So they want to do it right now so that they don't, although it is supposed to be a bit of, for SP itself, it's usually backward looking. What they try to do is they try to just write it down right now so that they don't have to think about it anymore moving forward. So apart from the national carriers and the large corporates, their OSV book has been written down to 0.3% of their book value. So for us, I think that it is a prudent move, definitely to move ahead of the curve when it comes to providing for allowances. So the first half, they actually reported 91 basis points in credit cost, which looks to be front-loaded, because if they were thinking about 100 to 130 basis points for the full year, it should amount to about 50 to 65 basis points in the first half, but they actually recorded 91 basis points. So it's kind of higher than expectations, but they did not lower their full year guidance. So they are expecting the 100 to 130 basis points in credit cost to stay the same for the full year. So the next half a year, maybe you will probably see about lower at about 40, 50 basis points as to be expected. In terms of outlook, for them, the semi-annual dividend was cut to 15.9 cents from 28 cents. So this is 43% below the previous dividend expectations of 56 cents per share, because their financial year 2020 payout was only 53 cents. So their 60% cap was at the current level of 31.8 cents. Yeah. So scrip dividend is available at 10% discount. So I think there's a question on what is scrip dividend. So scrip dividend is whereby you are supposed to get a particular amount of dividends. Say, for example, in terms of OCBC, 15.9 cents per share. You can use this share instead of receiving it in cash. You can actually opt in for additional shares for OCBC itself. And usually the price will be announced at a later date of what price you can buy in with the dividend, amount of dividend that you have. But because we know that sometimes say for example, you have $100 worth of dividend, but then currently the share price of OCBC is at about $9, close to $9. So you won't be able to make full use of the entire cash amount. You'll be able to get, they will tell you how much shares you will be able to get based on the payout amount that you are getting. So for OCBC, their dividend, their shares dividend will be at a 10% discount compared to UOB and DBS, whereby they have no discount. But this is not because they need to show up any excess capital. I think some of the people might be worried that, oh, they need a 10% discount because they want to save some money, save some cash on hand. But no, this is because I think OCBC was the one with the most recent one with share dividend history. So what they're trying to do is just hold their scrip dividend policy stable from the previous time, trying not to make too many changes, as it will not benefit the previous shareholders or the newer shareholders, sorry. So for OCBC, they did say that the application for the loan moratorium in Singapore will be tapering, has tapered off and peaked already, and is lower than expected in terms of the uptake rate. So for local loan moratorium in Singapore, they actually about 6 to 7% of their loan book is under the moratorium, which is below their 15% of loan moratorium expectation. So this helps them because moving forward, once all these loan moratorium actually expires, it will help ease some pressure. The non-performing loan formation should be lesser than expected as well. So yeah. However, across the three banks, what we need to know is that actually for Singapore loan moratorium, it is not as worrying as it would be in for Malaysia, because for Malaysia, their loan moratorium is on an auto opt-in status. So anybody with a loan will automatically be under the loan moratorium unless you opt yourself out of the loan moratorium. So for Malaysia-wise, the loans are all expiring. The loan moratorium will be expiring in September. So the next cut that all the banks are looking out for is whether past September, there will be a cliff effect resulting from a high number of non-performing loans. But because their books is also smaller, so even though there's a higher percentage of them that might turn to non-performing loans, it is still under control and within the guidance under their credit cost. So for OCBC, we are maintaining our cumulative call, but we did compress the NIM further by 5 basis points. So their earnings is expected to recover to normalized levels after they have already accounted for more allowances in the first half. So if they continue at this rate, I think by the time they enter into 2021, their allowances should go back to pre-COVID-19 levels. And that's it from me. I'll pass the time down to Natalie.
Okay, thanks. Hi, sorry about that. Today I'll be talking about Manulife's first half results. Next. Okay, so this is a relatively stable quarter for Manulife. The first half NPI and DPU were in line, forming about 49% and 47% of our estimates. On the positive side, we note that there was a positive rental reversion of 7.9% for the first half on the amount of leases signed. This was about 4.6% of the net leasable area. Okay, so there was most of them came from renewals, which was 50%. 42% of them were from new leases, and there was also a very optimistic 8% of expansions. So the leases signed were from the usual demanders of space, which are the financial, legal, real estate, as well as tech sectors. And the portfolio remains stable or resilient. There was no increased subletting within their assets, and no request from tenants to right-size or downsize or relocate thus far. Additionally, in terms of rental waivers and deferments provided, very minimal, only 0.3% for rental waivers, as well as another 0.3% in deferments provided for H1. On the negative side, we know that there was deterioration of rents. The rent collection deteriorated from 99% in April to 97% in May, as well as 93% in June. So a general downtrend. The management, however, commented that rents are still being collected, although the tenants are taking a longer time to make payments. They also conducted a valuation on their assets. This for the first half, portfolio valuation fell by 2.9%, pushing gearing up from 37.7% to 39.1%. So this deterioration in asset values, it fell by about 1.9% to 4.7% across the portfolio. So leasing activity remains weak. However, we remain optimistic on Manulife's resilience due to its longer WALEs, resulting in lower expiries for FY 20 and 21, as well as the tenant quality, which majority of them are actually in the legal and financial sectors, so about 22% and about 20% respectively, and their tight comparable supply in the markets that Manulife has a presence in. Cautious business sentiment has also led to the deferment of major leasing decisions, such as relocations, and resulting in more renewals. We expect the intensification trend to pause and due to social distancing measures, and hence providing some support for leasing demand in the near term. Additionally, statistics for office-using sectors show that these sectors, the financial, legal, insurance, professional services, and tech sectors, remain the most resilient among all the sectors. So we're maintaining our buy on Manulife with a higher target price of 90 cents. The higher target price is largely due to a lower beta incorporated in our DDM model, which resulted in a lower cost of equity assumption. So moving on to our next counter, which will be CapitaLand Limited. So for CapitaLand, this is their first half results. PATMI formed 33% of our estimates. Earnings are broadly in line as we expect a back-end loaded development earnings. So results were impacted by COVID-19, mainly due to the lodging as well as retail and residential segments. The retail segment expense of some $159 million in rental rebates. So on the positive side, we note that green shoots have appeared in China, which accounts for about 42% of CapitaLand's AUM, as well as retail, which is the largest sector for them, which accounts for 28% of AUM. So residential sales offices in China were progressively reopened in March, and since then the sell-through rate has been very encouraging. So in the first half, just 4 days in the first half, 4 days after the 24th of March launch date, all the units, 288 units in Le Botanical Xi'an were sold out. And the strong demand continued into the second quarter. So all of the units that were launched in May were sold out. These units come from 528 units in Le Botanical Xi'an, as well as 194 units in Park Botanical Chengdu. So it's very positive. So the sell-through rate for China remains high at 92% of all launched units. So most of the handovers in FY20 are expected to be delivered in the second half of the year. So while most countries are slowly emerging from lockdown, 95% of office tenants and 89% of business park tenants in China have resumed operations within their premises. So in Singapore, our numbers are still lagging. Currently, about 10 to 25% of office tenants and business park tenants have resumed operations in their premises. So this number for China is very encouraging. CapitaLand's core retail markets of China, Singapore, Japan, as well as Malaysia show evidence of recovery in footfall. Next slide, please. As well as in tenant side sales. So as you can see, the chart on the left, it shows that there has indeed been an inflection point for the shopper traffic as well as the tenant sales, indicating that actually recovery is underway. Next. On the negative side, we note that the EBIT was 1H EBIT fell by 71% year-on-year, and as mentioned, this was dragged down by the lodging segment, which fell by 82.5%, as well as the retail segment, which fell by 25.3%. So the lower EBIT was also attributable to fair value losses on investment properties in the first half of the year compared to a gain last year, as well as lower portfolio gains from asset recycling. So a multitude of factors here. Despite a weaker operating environment, CapitaLand managed to generate some $300 million net cash from operating activities. Balance sheet remains strong with $14 billion in cash and undrawn facilities, as well as we note that there was a healthy take-up of scrip dividends, which will help to conserve $388 million of cash for the group. So on the outlook side of things, the Vietnam residential inventory is running low, hampered by industry-wide longer approvals process. Additionally, COVID-19 presented an opportunity for CapitaLand to accelerate their digitalization initiatives. So some of these initiatives come from the virtual tours for leasing, as well as the showing of the residential projects, as well as the launch of their e-commerce platform, which is eCapital Mall, as well as the online food ordering platform, Capital Treats, in June. So this would help boost tenant sales and also drive new business for the group, creating an ecosystem for customer and tenant stickiness, and hence future-proofing their retail segment. CapitaLand is also able to, through strategic investments in a wholly owned flexible workspace operator called Bridge Plus. They are also able to tap on the core plus flex strategy of some of their occupiers, and also because of their very complementary office and business park footprint across their core geographies, this will allow CapitaLand to capture some of their hub and spoke demand. So overall, this very diversified portfolio, which is anchored by more resilient segments such as the industrial and office segments that will offset the more volatile or cyclical kind of lodging as well as retail segments. We feel that this diversified portfolio will actually help to is where the resilience is coming from. Overall, we trim our TP slightly to $3.82, keeping our buy recommendation. This is to factor in additional rental rebates as well as a longer than anticipated recovery in the lodging segment. There was also a slight enlargement of the share base due to the scrip dividend scheme. Okay, that's all for me. I'll pass the time on to Jie Hui, who will talk to you about IREIT. Prime.
Yeah, thank you. Thanks, Ned. Okay, so moving on to Prime US REIT first 1/2 results. NPI and GPU slightly surpassed expectations as we see minimal impact amidst COVID. Gross revenue and NPI was up 5.7% and 7.6% above forecast in 1/2 20, which is attributable to its accretive acquisition of Park Tower that was acquired in 1Q 20. We also see a stable lease expiry profile and strong leasing activity in 1/2 20. Portfolio will remains at 4.8 years, and only 3.3% and 7.4% of the leases by GRI are due to expire in FY 20 and 21. Strong leasing activity was also observed in 1/2 20 as Prime reaped 82k square feet of new leases and renewals, of which 30k of it was secured in second quarter. And this is done at an average positive rental reversion of 8.5%. Over 60% of 1/2 20's leases were renewals and expansions, and the portfolio's reversion potential is underpinned by leases that are rented at an average of 7.5% below market. Prime's gearing and interest ratio also improved, with 91.4 million of available undrawn facilities to tap on for future growth opportunities. And the only negative we have is that the occupancy dipped slightly due to expiring leases in 2 properties, which brought the overall occupancy down from 94.9% to 93%. Those markets still saw interest from the financial and technology sectors. Therefore, the management is not worried about bringing the occupancy back up. Okay, so for outlook, the supply remains low as the majority of the upcoming supply is pre-leased in those markets that Prime is in. The outlook for Prime still remains bright due to its income stability supported by a long WALE of 4.8 years, minimal expiries as mentioned earlier, and high levels of asset and trade sector diversification. Despite COVID, Prime actually still saw robust leasing activity in 1/2 20, which spilled over to 3Q 20. Post 1/2 20, an additional 36k square feet of renewals and expansions were executed by existing tenants at positive rental reversions. Therefore, we maintain a buy with a higher target price of 94 cents. We adjusted our revenue and NPI forecast upwards to reflect the new leases and renewals signed in 1/2 20. Our higher TP is mainly attributable to a lower cost of equity assumption from 9.5% from 9.96% close to 10% to reflect the relative resilience of US office class. Okay, so IREIT also released their 1/2 results. It's relatively stable. Gross revenue and NPI was up by 2.6% and 1.4% year-on-year attributable to the new lease at Munster South Building, which commenced in July 2019. However, DPU in Sing dollar terms dipped by 2.7% due to weaker Euro SGD exchange rates. IREIT recently acquired the remaining 60% stake in the Spanish portfolio, and we see less concentration risk in terms of market, asset, and tenant mix now that it's enlarged, and then it has also better organic growth possibility as the leases in the Spanish portfolio are 15% below market. This acquisition is to be funded by a rights issue. The good thing about the rights issue is that the key investors will undertake all rights units unsubscribed during the rights issue, so they don't have to worry about the take-up, and their gearing levels will be lowered, which position them for future growth. Yeah. However, this acquisition becomes DPU and NAV dilutive because they were looking to raise more equity to pay back the CDL loan and bring down gearing levels as well. So the theoretical ex-rights price will be around 66 cents. For the outlook, the take-up in office space and investment activity in Europe is expected to slow down in 2020. However, the office rents where IREIT's properties are located are not expected to be significantly affected due to low vacancy rates and lack of supply. IREIT's portfolio has remained resilient with majority of the leases supported by blue chip tenants. The impending acquisition will increase and diversify IREIT's asset and tenant base and mark what we believe to be the beginning to IREIT's growth plans now that it's backed by supportive stakeholders. Therefore, we downgrade our call to neutral with a lower target price of 68 cents. Our target price translates to a distribution yield of 6.9% and a total upside of around 1%. And we factored in for the rights issue to be fully funded. We factor in for the rights issue to fully fund the acquisition and repay the CDL loan. In light of more organic growth opportunities presented by the Spanish portfolio, we increased our terminal growth rate to 1.5% from 1% previously. Now I'll pass my time on to Terence.
Thanks, Jie Hui, and good morning, everyone. Next slide, please. We are recommending a buy on Koufu, which we see as a beneficiary of the economy reopening, and see their move into the integrated facility in 4Q20 this year as a major catalyst for the group. We maintain our buy recommendation on Koufu after their first half 20 results, but with a lower target price of 77 cents, previously 80 cents, as we tweak our financial year 21 and financial year 22 earnings estimates down slightly by about 3%, as the TOP of the group's integrated facility gets delayed to 4Q20 from 3Q20 previously. So for the group's first half 20 results, revenue and EBITDA came in at 46% and 43% of our estimates respectively for financial year 20, which is pretty much in line, as we have already baked in the impact of the lower footfall and closure of outlets into our estimates for full year 20. We also see a marked improvement in footfall in phase 2 of Singapore's reopening, and business operations in Macau have also resumed operations, albeit at a slightly significantly lower footfall as compared to Singapore. F&B retail is also a key beneficiary of Singapore's phase 2 reopening, and we saw the greatest in first half 2020 also sees a marked recovery in the second half of financial year 2020. We also see some of the stores that were postponed in the first half because of the circuit breaker also start to reopen, and the group also reopened their R&B stores rather, and also opened their first R&B tea kiosk in Indonesia in July this year. And for second half of financial year 20, we expect to see about 5 to 6 food courts and R&B tea kiosks open. One of the key negatives of the first half financial year 20 obviously is the expected TOP of the integrated facility being pushed back to fourth quarter of 2020. Previously, they were supposed to receive the TOP of this in the third quarter of 2020. But we have received news that the construction of the integrated facility has resumed, and they expect to move in to the integrated facility in the first quarter of 2021. For our outlook, we continue to remain positive on the group's outlook post-circuit breaker. We see the recovery in consumption post-circuit breaker, and the footfalls and revenue, especially when we do our site visits at the food courts and coffee shops in the phase 2 of the circuit breaker, is very positive for the group. And we expect the completion of the group's integrated facility in the fourth quarter of 2020 to see cost savings and additional revenue source for them. As a signal of Koufu's confidence for the second half of 2020, they have actually announced a dividend of half a cent against first half 20 earnings of only 46 Singapore cents. This signals really the group's confidence in the second half of 2020. On a final note, we will be hosting a webinar by Koufu's management this Wednesday at 1 p.m. So do sign up if you haven't to find out about management's outlook and plans for financial year 2020. I will now pass on to Timothy, who will cover Singapore's Bond Weekly.
Thanks, Terence. So today I'll be covering the bonds market. So right now we are still seeing the Asian bond markets is still quite buoyant. So spreads, which is the yield of the bonds over the benchmark government bond yields, is still falling, meaning that bond prices are still rising. And there's a strong shift of demand from the lower yield US Treasury bonds. They are yielding really low now, to higher yielding bonds in Asia. So last week we saw the auction for US Treasury bonds was very lackluster because most people are looking elsewhere for higher yields. So we're seeing a new bond issuance in Asia is still quite strong, and the take-up rate is still very high. So we're seeing still quite a lot of oversubscription for our local bond market. So we expect our local bond issuers to issue more bonds to take advantage of the lower rates that we have now. So today, actually, we have a new bond issue by Olam International. So it's a senior unsecured bond, meaning that at maturity date, they'll promise you back your principal. So the price guidance is around 4% per annum, and it's a 5.5-year bond. So it's minimum lot size is 250K for this bond. We think that the demand will be strong for this bond, especially because it is a Temasek linked bond. So it's 53.4% owned by Temasek and 17.4% owned by the Mitsubishi, which is a large conglomerate in Japan. So, but pricing wise, it's at a sweet spot. So 4%, the 4% mark is at a sweet spot for institutions. So we think that being Temasek linked and having the 4%, the yield is going to have a strong demand for this bond, or even though we are still neutral on the pricing. So it's not really that attractive pricing wise. For Olam International performance recently, there's resilience with regards to food products amidst COVID-19, but they still saw a weaker performance due to a lower commodity prices in the food side. So in the grains, cotton, coffee, almonds, pepper, and dairy products all saw lower prices, and also for their eat-out food products because of the COVID-19 measures of restrictions. But as of course, when they start to relax, then these things will rebound also. So the reason why they are raising this debt now, this bond, which is 5.5 years, is because they actually drew down a bit of cash for prudence wise for their liquidity. So they have a high proportion of short-term debt now, which is 60.5%. So they're looking to extend this their debt to a longer tenor so that it's more spread out. So for inquiries on this new bond, which is closing, which is only for today, this new bond IPO, you can contact our bond desk 62121818 or bonds@phillip.com.sg. Thank you. That's all. Next is Paul.
Thanks, Timothy. Okay, I have 8 results to run through. Firstly, on APAC Realty, we downgraded APAC Realty to neutral. I think the result was a bit of a disappointment. I think although profits, as you can see, PATMI at the chart was up almost 52%. There were several one-offs. Obviously, you got the the GSS grant from the government. Then you also had a $500,000 FX gain, unrealized FX gain from the foreign currency. And also, if you note, there's this points under the operating expense, there's this 0.7 decline. We also consider this as possibly a one-off, although they weren't clear, because what happens is that they actually subsidize their agents the $200 plus annual fee, but it wasn't clear whether this will continue. So we just consider it as a one-off for now. Okay, anyway, let's go through the bullet points. Firstly, the positive was that I think new home sales, as you can see under the up 16% year on year. So that remains the anchor to revenue growth for real estate agents, not only for APAC but for the others. The negative was that although profits are up, the dividend was unchanged. I think I think management is just a bit concerned that the weak economy will hurt buying sentiment into the fourth quarter 20. And do note that you don't see the impact of COVID on the results yet. Maybe on rental, because rental is quite immediate. But as you know, there's a lag impact. You may transact, have a transaction today or make a booking today, but the actual completion could be like a quarter away for them to book revenue. So the full COVID impact, the April lockdown, will only be felt for them and also PropNex in the third quarter numbers. Okay, just in terms of outlook, I think nothing much. I think they're a bit cautious, but I guess the only positive that we gather from the results was that they're aggressively expanding overseas. I think they're moving quite aggressive, buying stakes in Malaysia, Indonesia, and Vietnam. So this will help lay a foundation for growth outside Singapore, and this is a positive for us. Asian Pay TV, next. Okay, in terms of Asian Pay TV, if you look at the first bullet, the first on the table on the left, the revenue line, you can see that the weaker Sing dollar actually contributed 7.8 percentage points of growth. So when you saw see basic cable TV rising 4.3, so don't get too excited, because part of it is because of FX. But also the other one-off, apart, I mean, if you consider FX a one-off, the other one-off was that there was a 5.4 million settlement fee. We kind of heard the headline numbers. What happened was that there was some programming cost that they had to make settlement. Maybe they provided too low, so they had to recover back. So in terms of the positive, you know, our whole thesis for Asian pay TV is to focus more on the free cash flow, as you can see from the table on the left. So that was up almost 91. Part of it was some deferment in capex, but more important for us is that the free cash flow needs to be healthy so that they can pay the dividend, as you can see from the table below, that minus 4.3 million. Okay, the other positive was broadband subscribers was up. You can't see from the numbers here, but actually it risen. We'll explain later. The negative was that they lowered their DPU because they did a rights issue. We already kind of accounted for it, and they've already factored this out last month. So instead of 0.3 per month, per quarter, they're paying 0.25 or 1 cent. They will review their dividend policy in the next third quarter results. The one-off settlement fee, the next bullet point I think we mentioned. The other thing was the jump in broadcasting fee, broadcast costs. I think you can see from the table on your left again, the broadcast cost. We were a bit surprised, but they said there was some accruals. I think maybe they kind of under-provided the prior quarters. So right now they're just making it up, but they said full year it should be stable. In terms of outlook, one way to kind of look at this company very holistically, every year the subscribers are rising about 2%, but the ARPU is the one that's hurting them. So net, they are probably declining revenues about 2-3%, or maybe earnings are declining about 2-3%. Just very holistic. But anyway, we still have a buy call. There are three main reasons. Firstly, that we mentioned that we think dividends are sustainable. We'll show you in a chart later. But I think the free cash flows are much higher. As you can see from the table above, the free cash flows is 13 versus the 4 million that they have to pay every quarter. The second bullet point, you can see at the fourth last row, up number 2, is the upside from 5G. I think what we see is that once, like we mentioned before, once 5G is rolled out, they will tap on Asia Pay TV's backhaul. So what it means is that when 5G roll out, you need to connect all the base stations with fiber because the data load is heavy. And unlikely the competitors will want to use Chonghua, which is the incumbent, which is the so-called Singtel equivalent in Taiwan, and want to pay a competitor for this. So, but again, they've not really been, they're not really disclosed how much is the amount, but they just say that it's a material contribution. The third point is that operationally it is more stable. I think subscriber growth, if you combine premium TV broadband, is actually helping the decline in the basic cable TV. Okay, and for this is the one of the points I wanted to show. So the table on the left, as you can see, although cable TV is declining, when you add in the premium digital and broadband, actually they are starting to rise in terms of total subscribers. So at least operationally there is a bit more stability. The only issue now, like we mentioned, is the ARPU, which is our selling prices. Then the key one is the table on the right, which we shown before. So as you know, in 2014 to 2018, the rate bar, that was the whole issue that they faced. The dividends was just too high compared to the free cash flow. So obviously they made a big cut in 2019. You can see dividends just collapsed, the rate bar, and now it's a much more stable, and it's turning more stable. As you can see, 2021 free cash flow is much higher than the dividends, and one of the reasons is that baseline, because capex is coming off. I think they are investing quite a bit right now still because of fiber, because they're preparing for the 5G rollout. ComfortDelGro, okay. For ComfortDelGro, as you know, we're not like the ultra big fan of ComfortDelGro. I think we've shown before, because of the competition from Grab. Buying them is like almost like, I'm just saying, almost like shorting Grab. But anyway, but we did upgrade it today. I think we just came out with a report. Some of the reasons is in terms of the positive on the results. Firstly, the results is a whiteout. I think don't have to. I think the whole of 2020, just forget it. They had to give rebates of 116 million to taxi drivers, which actually just goes straight to the bottom line. So it's obviously the whole 2020 is gone. But in terms of the positive for the first half results, the bullet point on the right, actually we were surprised that they actually did generate almost 240 million of cash flows in the first half. And it only just shows that, this business is very high fixed cost. Depreciation is 400 and the staff is about another billion. So they're very heavy on the fixed cost. So that's why the operating leverage works both ways. Okay, the negative, I think we all know, I think public transport, nobody's traveling, so the whole thing just dropped now. Okay, and then taxi operations sunk to a loss. And then obviously, and also the other point is that the third point under negatives, they did not pay a dividend, interim dividend. I think the year ago, you can see from the table, they paid 4.5 million. I think what has helped them is the government support. Basically, if you exclude the government relief, actually they would have suffered a net loss of 66 million. So right now, so you can do your own estimate. They actually still lost 6 million. So the government support was almost about 70 million for the first half, roughly, and it should actually still continue into the second half. Just a note, I mean, the results was also a bit bad because they had a 22 million impairment for the taxis. So what happened is some of the older diesel taxis that are that they're going to scrap. If you keep the taxis, you still have to maintain, it still costs money, so they're going to scrap. Okay, in terms of the outlook, in terms of right now, what they mentioned was actually the taxi drivers takings are actually maintained probably around 3,000 plus and per month, and what's because the government is providing at least 1/4 of the support. It's hard for us to measure the momentum in taxi because we don't have the data point. But the only positive is that they are going to remove the rental rebates slowly, progressively, and that should help lift earnings in the second half. In terms of public transport, I think we all know, nobody traveled during the breakdown. But we'll show you a chart later that the rail traffic is starting to come back, and they also for the bus, they're actually tendering two more contracts, which is by their competitor Tower Transit, the Australian company, and also SMRT. So of course, if they win that, it will be a positive for the growth outlook. Okay, in terms of why we upgrade, actually it's accumulate. Sorry, not buy. Actually, it's close to buy. We acclaim and sorry, the whole thing is out. It should be 150 previously. Sorry for the error. But why we raise it to an accumulate from neutral is because we see this as we see Comfort as a preferred proxy. As we all know, the worst of the lockdown is over and things are easing. We could even enter into phase 3. So as things ease, I think this would be our proxy to the recovery in activity in Singapore. And always remember that Comfort has a huge 60% share in bus and taxi services, and also almost 40% share in the rail network. And it's very hard to find any company with such a large market share in any business in Singapore. And also because of the high fixed costs, as you know that they went into a loss because of the high depreciation. So when things turn around, the growth in earnings can be also much faster. This is just to show the taxi fleet is down 13%. I don't think their market share really moved much in terms of their fleet. Maybe up maybe a little bit, 1 or 2 percentage points. If you compare to the private cars, so-called IE kind of Grab, I think theirs was down 5%. I think the private cars were down 4,000, taxis were down about 2,000 plus. So taxis, in terms of percentage, actually came off more than the private cars, which were down 5%, so taxis down 13% this year. And the chart on the right is just to show how sharp the increase in traffic. In terms of real traffic, it tripled. I think in May was 195, then now it's 600, you can assume it rising. NetLink is just an update. They didn't produce any results, just some highlight, but I think it's more or less the same. I think there was some disruption. Because of the lockdown, nobody can install. Even your customer call you 10 times, you can't go because your workers are not available. So that's why you can see under the non-residential basically is connections to all the businesses, all the offices in all the buildings. So that was actually down because they typically have cancellations during the quarter, but there's no worker to install. So I think in a nutshell, you can understand what happened. So there was a temporary disruption. But they were compensated, I think, as you can see from under the positives. The EBITDA still grew because there was a 2 million from the job support scheme and another 1 million property tax. So that kind of helped the EBITDA grow at least this year. Outlook is I know things are getting back. It has already back to normal capacity right now. We maintain our accumulate and it's giving about 5% yield, very stable. PropNex. Okay, and for PropNex results, the earnings, at least for the second quarter, they did about 7 million for this second quarter. For the first half, they made about 15 million as compared to Apex. They made, as you saw in the previous slide, Apex made 7 million and PropNex made 15 million. So I guess we know who's gaining market share. But anyway, in terms of the positives, the positive for us was that even though, you can't see the numbers here, but even though the first half, the revenue jumped 45% to 241 million, the cash drain on the business to grow, we were surprised that the working capital was only 300,000 to grow this, and also capital expenditure again was hardly anything. 100,000, maybe some renovate some offices or something. I'm not very sure what it was, but it's just to remind everyone that they don't really require a lot of capital, and what this company just generate a lot of cash from our point of view. Okay, in terms of the results, what drove the earnings similar to Apex was the project marketing, which is new launches. As you can see from the table on the left, project marketing was up 150%. That was the main growth driver, and they also raised their interim dividend by 20%. And I think they also reminded everyone that they will maintain this stock. Their plans is always, there's no official dividend policy, but they will try to maintain this stock as an attractively priced dividend paying stock. So right now they're paying about 6% dividend yield. Okay, in terms of negative, there was a bit of a higher staff cost, and we're always a bit wary when staff costs rise too much, if it's not bonus related, because we always worry when they bring up too much of the fixed cost. In terms of the outlook, I will leave it for you to read, but just some general things. In terms of new launches, it will be the mass market, in the RCR region will be the best selling projects because of HDB upgraders, and we've also also seen, this is not in the slide, but we've also seen some pickup in volumes. I think the volumes in June and July was about 1,000 units, and also July was also 1,000 units. These are quite big numbers considering the whole of last year it was about 10,000. So if you can trend at 1,000 a month in terms of new units, it's actually a big number. And August so far, half year so 500. So we could be into the third month of 1,000 units. So actually new launches are performing pretty well. In terms of the resale or second-hand market, that is not doing well. I think that one is going to be very weak. I think one of the reasons given was that sellers obviously are not lowering the asking price, whereas developers are more willing to cut prices. HDB resale will be more stable because of the attractive HDB grants, and also what was mentioned was that because of the delay in construction activity, so maybe buyers or i.e. kind of married couples would rather buy resale than wait for a new BTO that's going to be kind of delayed even further. So we maintain our buy with a high target price, but do note that the third quarter is going to be weak. Like we mentioned earlier, the impact of COVID is not here yet. Impact of COVID only in rental market obviously, but the impact of COVID is going to be felt more into the third quarter, especially new launches, because launches drop. Nobody buying property during the lockdown. I think only like 200 plus units transacted in April. Yeah. Okay. Anyway, next, and also just a reminder. Slide before that, the 7% yield is a $15 million payout. Their free cash flow the last 3 years was about 20, so they can more than cover. And of course, they also have a buffer of almost 100 million cash in the net cash in the balance sheet. Thanks. Next slide. StarHub results. Okay, StarHub was weak. I think the main problem was been, as you can see from the table on the left, the mobile. And the main reason why mobile is down 25, and 25 is a big number for the decline 25, was because of the ARPU. ARPU was down 25% year on year. ARPU, as you all know, is selling prices. Postpaid ARPU is because of the roaming like we mentioned before. I think without outbound or inbound roaming, I think they lose maybe 10% to 15% of the revenues possibly, and a lot of it goes straight to the bottom line. So that's why it's hit. It hurts them. The positive, go back to the positive, the first bullet point. I think pay TV was unchanged, and that was good. I think in terms of the revenues, quarter on quarter is stable. As you know, as you can recall, last year they cut the whole cable TV and moved everyone to fiber. So of course there was a lot of churn, and obviously we're always worried that we need to find some stability, and at least that has started to stabilize, and the prices even went up a bit. I think the negative, we all know, mobile ARPU. Interim dividend was cut, as you can see from the second bullet point under negatives. Interim dividend was cut to 2.5 cents. This is a big 45-cent decline from 4.5 cents last year. But important to take note, management is still guiding at least 5 cents for this year. So what they're saying is that, first half is 2.5 cents, but second half they will pay at least another 2.5 cents. So that is their commitment. So you can assume 5 million is the 5 cents, is the minimum dividend for this year. In terms of outlook, the outlook will be quite grim for the next 2 quarters. I think my report put 2 years, there was a typo anyway. 2 quarters because you're still going to have the year-on-year impact. So third quarter, last year, there's still international travel. So third quarter, no international travel. So you're going to have this weak numbers for at least the next 2 quarters, the year-on-year. So you can expect weakness in the second half further. So we maintain a neutral and just that there's going to be very sluggish earnings moving forward. Okay, so UG results. So UG is a glove maker. So the results was out. The revenue was up. This is second half revenue was up 80% and profit was up 9 times. I think the bulk of the first bullet point, the bulk of the jump in profit was due to the increase in selling price because their capacity was more or less stable. We don't have numbers on actual units produced or utilization, but obviously most of the growth came from selling prices. And operating leverage, I think in the past the operating expenses was rising faster than the revenue because they were growing their base in other countries like Brazil, China, like building warehouses and all that. You can see from here in the table the operating expense is up 53, but actually most of it was due to FX loss. So it's not really them group like building more warehouse and so on. That's why on the negative we put FX. In terms of the outlook, what we think is that the bulk of the second half numbers that you see, the 12 million, we think most of it came from fourth quarter because April, the prices only started to rise in April. So what we think is that maybe 10 to 11 million net profit came from 1 quarter alone. So that's why we think that for the full year, if you analyze the 10 million, they can easily hit 40 million profit for FY21. And as you all know, prices went up further even in July, August. So there is upside to that 40 million. So we maintain we always just peg it to 15 times PE. And the other positive was that they're going to raise their capacity by 60% in 2 stages. So that will be another spurt to growth. Just one final point on UG. For those who want to find out more, or even you can ask questions, they're doing a webinar with us later at 3 p.m. today. So it's in the Poems events page. So if you want to sign up, just go ahead and register. Okay, I think this should be my last venture. As you can see, Ventures results was down 25, and you can see it's quite empty. You don't have much to say because they don't really tell you much anyway. So anyway, we actually downgraded to neutral because our pricing, we always have it under the downgrade to neutral. We always price them around 15, 16 times PE. But anyway, just to go back to the results, the positive was that the interim dividend was up. They raised by 25% to 25 cents. And I think they said they increased it because it's one of the reasons is that they want to show that the outlook for second half is better. Although they don't tell you why, what products, what programs, but anyway, just have to believe them. And the other thing is that one of the reasons dividends increased because their cash is still really huge. I think they got 833 million as of June, whereas a year ago was 760 million. The gross margins also increased. And this was a surprise for us because, when revenue is down, you normally have lower scale, but I think they're just building higher end products and that's a positive. The outlook, as we all know, the weakness in first half cannot be represented because I think they virtually shut down in April because the lockdown was not only in Singapore, was in Malaysia, and most of the capacity is in Malaysia. So we do expect second half to be better as they spill over some orders into the second half. And they mentioned 2021 there will be new products. So they seldom are that specific, but they seem to be suggested 2021 should be even better. Okay, I think, and again, we still think that they are attractive, although it's neutral, but no, they pay a 4% yield. And I think life sciences, basically healthcare products, and the shift from supply chain will be from China to Southeast Asia will be some of the drivers to their growth. Okay, I think that's it. We can take questions now. Just one last point. Our webinars, we used to do it once every 2 weeks, unless it's a holiday. But right now, every Monday, we will conduct this webinar on 11:15. Just for everyone's knowledge, in case you did not know. Yeah, thank you, everyone. Please feel free to ask questions. Thank you.
Okay, thank you, Paul. I think I'll start off with the questions. Quite a few questions for the bank side. Okay, I think there was one that trying to ask me to explain the scrip dividend, which I answered during my part just now. Okay, just give me a moment. Okay, and the next one, there is whether the scrip dividend entitled is to future dividends declared. I think there's two of the similar questions. Okay, so for this scrip dividend, I think, if I'm not wrong, right, what the banks have is they will send all the shareholders a dividends election form to opt in for the scrip dividend, and under that form you should have an option to choose whether you want to reinvest all your future dividends in terms of shares. So you can actually, I believe you can actually have the option to do that. Yep. So that's that. So no need to worry about whether having odd lots and everything. Yeah, and usually, yeah. So that's the part for the dividends. And I think there's a few asking about whether my accumulate recommendations, even when the current prices are quite close to the last done price. Okay, so basically for our side, because we band it in terms of total returns. So as long as your total returns is between 5 to 15%, or 15 or 20%, I think. So it should be under the accumulate call. And the total returns include both what we think the target price will go to, plus the dividend yield that we expect you to be getting. So if you actually calculate right now, I think the total returns for the banks will range between will be around the 5% mark. So you see it's like a neutral to accumulate, is always hovering around there right now. But what we do think will be good going forward for the banks is that we see that all the credit costs has already been taken in. So we are expecting 2020. So for the remaining 6 months, maybe that should be where the end of all the additional credit costs allowances that we book. So most of it, because most of them front loaded their allowances in 2020. So we are expecting the picture for 2021 to be much better. That's one that's headwind, sorry, not headwind, the tailwind that will be going for them, sorry. And also, once they are, assuming nothing worsens based on the current situation, when they go into 2021 and they can resume their previous dividend payout, and I believe that they have the ability to resume back to the previous estimates, and that will allow them to, the dividend yield to go up much higher. So even based on the current prices, it will be a accumulate call. Yeah, so that's the main reason behind why it's still accumulate. But I think when I issue my report at the time, based on the last time price, most of them are above 5%. So which is why they will accumulate at a point in time. Okay, I think there is one that says whether it's good to get a scrip dividend for DBS. Generally, so for the UOB and DBS, we know that their scrip dividend is not at any discount. So the main thing to take note of is how much dividends you're getting. If you have a very huge holdings, you have a very large holding, sorry, and then the amount of dividend you're getting, right, is actually, if you convert it to shares, it is actually quite significant. Then maybe it will be better for you to opt in for the scrip dividend. But if you're holding a very small amount, say for example, you only have 100 shares of DBS, which means that this quarter you'll get, let me calculate, 18 cents times 100. Yeah, if you base it on current prices, you get like $18. I'm not sure whether you will even be able to. I don't think you'll be able to opt in for scrip. If you only have 100 shares, you get $18. You're not enough to offer. You be offered even one share of DBS. Then of course it won't be a efficient way for you to get your dividend. I don't think you have the option to as well. So if you can get more than, I think, 10 shares, I think it should be quite good to actually opt in if you want to. But definitely in terms of upside, once you recover And also, if you think about long term, if you think that the banks will start to recover, is definitely good to start reinvesting a little bit by a little bit to increase your holdings of TBS. So I think there's also another one just to clarify. So when we say accumulate, basically, I think it's just a general question lah. When we have our ratings in Phillip Securities Research, we have buy, which is by right, it's supposed to be more than 15 or more than 20% upside. For accumulate, it is between 5 to 15 or 20%. So it is still a positive. For neutral is -5 to 5%. Then I think below neutral is, I know sell is below 15 or -15 or -20%. And the middle one I think is to reduce. Yeah, to reduce is between 5 to -15 or -20%. Yeah. So that's our 5 classifications. I think that's it from the bank side. Okay, I'll take on a few more questions. I think one there was, can you comment on Great Eastern, whether there's any upside? Okay, so I don't really go in depth into the Great Eastern business, but I think if we were to bank on what we saw in the first quarter and second quarter, the recovery of Great Eastern's contribution to OCBC, right? I think most of it has already been priced in, unless you are expecting the equity market, or not just the equity, but the entire capital markets to having a lot more upside, 10-20% kind of upside. Otherwise, I think generally it's been priced into OCBC's share price. So that's for that. Then there's also whether there's any bubble forming in SGX and other stock markets. As investor, what kind of indicators have to? Oh, sorry, that one. I think I'm not that great to answer that. I think there's another one. Whether there's DBS Bank, I think there's a 4.7% is also affected by the dividend cap. So for that, right, because the 4.7% that you buy is actually a perpetual bond. So the 4.7%, no, it is not affected by the dividend cap. You still get your 4.7% per annum. Yeah, I think that's it from the bank side. Yes, so the rest can take over. Thanks.
Okay, sorry, I'm not sure if everyone can hear me. Okay, I'll take some questions. First of all, the first question I'll take is CMT and CCT still going to merge? If so, which counter to buy? So the answer to this question is the long stop date for the merger remains at September 2020. So by then they should, both REITs will have to conduct their EGM for the vote in order for this to continue. But from what we know, it's still ongoing. And which counter to buy? So actually at the current market price, it's all priced in already. Meaning to say that factoring in the exchange ratio of 0.72 CMT shares for 1 CCT share, as well as the cash component of 0.259 cents, dollars, so 25.9 cents. The market prices are adjusted in already. One thing to note is that based on our TP, there's actually a higher total return for CMT. So the total return for CMT is 29.7% versus for CCT, which is 22.6%. Yeah, this is also partly understandable because commercial assets tend to have lower yields. So I hope that answers your question. In terms of market price, it's all priced in. Okay, I'll take another question. Between Manulife and Prime, which is the better buy? So for both of these counters, we have a buy call on them. A slight difference is that I think for Manulife, the total return is slightly lower at 28.4% versus Prime's 30.1%. So it's a slight difference there. In terms of portfolio quality, both of them they own Grade A assets. Manulife owns 2 trophy assets in addition to that. In terms of asset diversification, Manulife has only 9 assets versus Prime's 12 assets. So in general, very similar, even in terms of tenant quality. So if you want to pick on the details, probably you can say that the return for the deterioration of collectibles or rent collection for Manulife is more pronounced than that of Prime, which is like currently in June it's about 93%, versus I think for Prime throughout the whole 2Q was at 99%. I think one more important point is that in terms of trading volume trading volume for Manulife is higher at about 3.5 million volume per day versus Prime's 0.7%. And Manulife is Manulife is also in a very prominent index, which is the FTSE, the IPRA NAREIT Developed Index. Yeah, so I think that will help with the liquidity as well as the movement of the share prices. Yeah, but we like both of these counters, and we think that they are resilient. Their whales are long, as well as the the outlook for the U.S. office sector is very positive. That's all for this question. I'll see if I can take some more questions. Okay, so another question about Manulife. The stock is currently trading at 1 times NAV of 0.76 times. Based on TP of 90 cents, do you expect NAV to increase, or are you expecting the price to NAV to increase? So I think we will expect the price to increase, hence leading to an increase in the price to NAV. So it's the second scenario here. In terms of NAV doesn't really change very much over time. The NAV, we possibly might see like minor increases or decreases in NAV, but I think the main movement here will come from the share price. Sorry, another question will be any advice on CD development. So for CDL, the report will be out soon. So in general, I think just talking on the results here, it was a challenging quarter for them. Mainly, the main impact to them was probably the hotel operations. Nonetheless, I think the share price is currently trading at a very big, almost 40% discount to the NAV. So it will still be a buy call for city development. Yeah, and also, as you know, city development has a very large portion. I mean, they're still very dependent on residential kind of revenue, which is your development revenue. So they tend to have very lumpy and swings in their revenue recognition. There's another question, which is it better to buy the parent CapitaLand Limited or their children, i.e. the CapitaLand REIT, and choose the sectors selectively? I think this question it's very different, because if you were to buy CapitaLand, then that would be, you will have the returns from the development side as well as the fund management side, which is completely different animal compared to on its own, the different REITs. Even within the CapitaLand group, they also have a hotel management, which is the Ascott Limited, the wholly owned entity, which is called the Ascott Limited. So it's a very different animal altogether when you put it together. So it yeah, I wouldn't compare them that way, I guess. And I think I'll pass the time on to someone else first.
I'll just do one quick one. Before we move on to the Koufu questions, we just take it in chronological order. Hi, anyone can comment on China Mobile and China Telecom? My apologies, we don't cover both stocks, so sorry for that. Next one, I'll move on to you, Terence. Most of them are Koufu questions.
Yep. Okay. Thanks, Paul. So, first question, could you please explain how the integrated facility is able to provide additional revenue for Koufu, by how many percent approximately? So for Koufu, there's additional revenue that we see will come from the integrated facility through the leasing out of their space. I think for Koufu, they've committed about 1/3 of their space in the integrated facility for external partnerships with other food players, so that they can do different types of R&D on different products. So that they can pander to the consumer's taste like in Singapore. Another thing that Koufu is exploring and have really tried to do is the cloud kitchen. So before I go into the cloud kitchen, let me just probably define what a cloud kitchen is. So these are premises. These are stores located off-site, so not at your typical food courts or hawker centers, so they're all located at an integrated facility. And the good thing is that the rents are cheaper. You don't have to put up a store sign, so the setup cost is generally cheaper for people who want to try to go into this. You don't have such a high barrier to go up to go and set up something like that. So this was actually very popular during the circuit breaker, because people cannot go out, so they just call, and then they can actually just do the delivery straight from the integrated facility . So some of the players who have already done something like a cloud kitchen are like players like Foodpanda and Deliveroo. Grab also recently announced their intention to go into cloud kitchen. So this is one area that they can do. So okay, but how many percent? Approximately, we estimate the additional revenue to be about $500,000 to a mil. So that would be a margin improvement of about 1 percentage points. Next question for Koufu: how does the delay in the TOP affect the revenue and cost? If the TOP is delayed, shouldn't the cost this year be lower instead of higher? So I answered the revenue question already. So on cost, in terms of cost savings, they will moving into the integrated facility. Will enable them to move out of their two current factories at 18 and 20 Woodlands Avenue. So we expect them to have different plans for the two factories. One is that they can continue to operate different businesses inside there, or we think that they are more likely to actually sell the two premises at 18 and 20 Woodlands Avenue, which could lead to a special dividend, about 50% of the profit. So we calculated that to be about 1.4% in additional dividend from where they are currently special as in terms of a special dividend. And then they also have a recent acquisition of Delhi Asia, which they just completed in July. So Delhi Asia is currently operating in two premises or two factories also, and then once the integrated facility is set up and they move in first quarter of 2021, then this will lead to immediate cost savings on their most recent acquisition, because they will then not need to continue leasing the two factories there as well. Then there are other obvious benefits with moving into the integrated facility, such as economies of scale in terms of procurement and a centralized dishwashing, things like that, which we have already imputed into our FY21 and 22 earnings forecast. Okay, I think there's just one more at the bottom. Not sure why is that the case. So I think this participant wants to know the view on Koufu versus Kimlee, as they are in similar business. So they are. Kimlee, like Koufu, is expanding the number of food courts that they already have. So they've been very aggressive in terms of bidding for food court spaces that they have. But Koufu has a stronger growth profile versus Kimlee. So Koufu FY19 earnings per share, for example, for instance, Koufu's financial year 19 earnings per share grew at about 5%, and Kimlee came in at about -8%. Net profit margins for Koufu is also higher. I think that's by 2 percentage points. Koufu is about 11.7%, and for Kimlee, they are at about 9%. So ROEs and growth profile, Koufu is ahead of Kimlee. So I think we definitely like Koufu a lot more versus Kimlee for that reason. Okay, I think that's all the questions on Koufu.
Thanks. I'll take on some. The next question is, UG Healthcare is going down. All the glove stocks going down. Is that a trend due to the vaccine by Russia? Is that real? So the Russia vaccine is nicely called Sputnik 5. There's not much data, any vaccine takes phase 1, phase 2, phase 3. So the only thing that they mention is there's not much data on phase 1, phase 2. They just say that they've passed and they're doing phase 3. Of course, the biggest endorsement is that Putin's daughter has used it. So I guess if you're Russian, you better use it too. But apart from that, it's very dangerous, I guess. What we get is just from the press. It's dangerous for any country to take on such a vaccine. Firstly, you don't know whether it works and whether it's dangerous. And the other reason is that if you really use it on your population and it doesn't work, that's what you can imagine you're actually spreading the virus. So it's going to be very challenging for any country to take this on unless there's really a lot of data backing the test. And they didn't even go through all 3 tests. In terms of the stocks going down, I guess a lot of the good news has been there, and a lot of the results has already been out. So I guess you need to have another set of results or news that ASPs are rising again, which maybe you can ask UG 3 o'clock later for the momentum to continue. This is just the latest up-to-date information. I hope that helps. In terms of the TA technical analysis for you, the next question, can you kindly provide the TA for UG? Why did the share price drop post-reporting in spite of the great results and future outlook? I mean, we can only say that we not only for UG, I think all the glove makers from Malaysia too. I think Malaysia usually takes the lead for the glove stock performance. In terms of the TA, I think in the interest of time, I think some of your questions, again, thank you everyone for your questions, because I think he has a TA session soon. If we can't answer it, please refer to the stocks BNB. We're going to post some of your questions and type it out in the website under the community page. So I really apologize if we can't take on all your questions, but we will try. So for this TA question on UG, I think he might either issue a note or just post it on the community page.
Paul, I can just do a short one.
Okay, yeah, thanks a lot. I'm sorry.
So take on from UG. So UG Healthcare actually has a very great bullish run since start of this year, January. And then actually, if you look at the wave analysis, it's actually complete the 5 primary phase of the impulse wave. So the correction is quite timely. Actually, the third wave, you look at it, the third wave is already extended. So and then we are looking at the 5th wave extension also. So to me, the sharp fall that we are seeing from like last week on the 12th of August, is it going to be a turn of tide? I won't say so unless $2 and $2.10 support level is broken. Then I will see a new rebound area at 1.66. So otherwise, I'm still quite bullish on the from technical outlook. The UG Healthcare is quite bullish. Same for Top Glove as well. Thank you.
Okay, thanks. And again, 27, we'll probably have a webinar with Top Glove too. So if anyone interested, it's not in poems now, but it will come out. I'll move on. Thanks, Viren. Move on to the next question. On NetLink, when all the homes are done or saturated, are there new streams to sustain the share price and dividends? What will happen is that if you assume, because every year there are about 20,000 households formed. I mean roughly, not the exact number, but so that will be the area of growth for NetLink. So we are assuming the growth will just come from new household formation and basically new married couples and new HDB being built and so forth. So that will be the growth for them as new houses, and then people need to sign up for the fiber cable. I hope that helps. I think the next one, Natalie, you can take.
Hi. Okay, so I will take the question on, do you think CapitaLand shares could recover in the near term? I think our TP is $3.82. I think definitely this TP is a rough guide for about the next 10 months, and we do think that it will recover, but it will within this like horizon, 1 year horizon.
The US dollar
can Min go up?
Oh, the very top.
Sorry?
Have you answered the prime and in US dollar with US dollar drop? You answered that, is it? Sorry.
We haven't actually calculated the net effect, but so far, I think since March, the US dollar has dropped about 6%. Yeah. And I think we initiated like later on, which was like about 20th of July.
Okay. Let me just read out the question. Prime REIT and Manulife REIT are in US dollar. With the US dollar dropping, so the returns will be affected, but not sure how much the net effect. Anyway, you know, when you buy this, the stock is listed in US dollar, they earn everything US dollar. You take US dollar risk, you cannot avoid that risk. But what we're trying to say is that for a US dollar asset paying 8% yield, we just think that it's very attractive. I mean, US dollar, and you know, interest rates continue to remain low for at least the next two years or so, or even more. So you cannot avoid. I think US dollar risk is something you have to take on, because these are US dollar assets, everything US dollar, you cannot hedge it out. The next one, I'm not sure whether I used it there, but what is the reason that caused gold price to fall recently? I know I don't really follow.
That one I'll answer in my next webinar in US. I've prepared it already, so I'll answer that question later on. Thank you. So
thanks for that question. Sorry, he'll be doing a webinar later at 1 We will try to answer last 1-2 questions because he has to go over to the side. Is there any bubble? Is that answered in the SGX?
No, it's not answered yet.
Okay. You want to go?
I think the bubble one is more of a general market, though I don't really.
Oh, okay, sorry.
Yeah.
Is there any bubble for me in SGX and other stock markets as investors? What kind of indicators do you like to predict that? I'm not sure it's a bubble because the STI is down 20%. It's probably a reverse of a bubble, maybe. Maybe US, I'm not sure, but at least for the Singapore perspective, our valuations are probably at record lows. If you take into account especially the dividend yield and price to book basis. I hope that kind of answers that. What is your view on Riverstone? For Riverstone, they were similarly, we think quarter on quarter, the profits could actually double. That means not year on year, only quarter on quarter alone. We don't cover, but of course we do monitor. And Riverstone typically should, my own view is that they should actually even trade at a premium to some of the large ones in Top Glove because they serve a very big niche, which is electronics industry, and they are probably the leader there. They never revealed the market share, but I think they got a huge market share for that, for electronics industry, providing gloves. And the margins there has always been high, about 30%, because healthcare gloves, which used in hospitals, tend to be about 16% for everyone, but theirs was about 30%. So we always thought that they deserve some premium because they got such a strong hold on that. Sorry, we don't cover, so we can't really answer that. We tried to do the last few. A few webinars ago, Paul did take on the Sembcorp Industries and Sembcorp Marine merger. Any latest comments following the recent EGM to go ahead with the demerger? What now for Sembcorp Marine that Temasek has dropped its plan for capital? As you know, we don't cover, but I'll just show you, these are my own views. We don't do like some hardcore analysis, but I just worry that Sembcorp Marine probably might get another round of selling. I think like we mentioned before, now that Sembcorp Industries minorities are going to get hold of Sembcorp Marine shares, and most of them are not on paper, at least free on paper. There could be another round of selling, and they account for almost 1/3 of Sembcorp Marine's current share base. So we just worry there could be another round of captive selling. In terms of the merger, we were also surprised that we thought they could just lower the bid, but we think the possible thing could be maybe we're only guessing and we do not know. There could be likely scenarios, maybe Sembcorp Marine just buying Keppel's yard. And I think the Keppel will be more than happy to sell. And if that happens, that will be positive for Keppel. The next question, what is the main reason for your target price for UG at 415? What we did was we take 55 million net profit times 15 times PE. Okay, I'm not sure I can answer all the questions, but for ComfortDelGro, sorry, we need to cut, is it? Yeah, okay, I think the rest of the questions, we will take it offline. I think that's quite a number. So we will take for ComfortDelGro all that offline if I can. Right, I think we need to end this, right? Viren, you have a call. Okay, then I think, so sorry everyone, the balance of the questions, we will just post it in our community page. Yeah, I know it's a bit rude not to answer all your questions, but we will just post it there. So sorry, because he has to cut out and then go to another webinar, and we need to vacate this portion. So thanks again for attending, and we will see you next Monday. And don't forget of our webinars. So Monday, today we have UG, tomorrow we have Sun Power, and Wednesday we have Koufu. Thanks again, everybody. Bye-bye and take care.